In 2026, millions of people wake up every morning, go to work, earn money, and slowly fall behind anyway. Not because they're lazy, not because they made some catastrophic mistake, but because they're playing a completely different game than the people getting richer. One group works for money, the other owns things that make money. And the divide and line between those two worlds is something most people still barely understand: the stock market. Three words that somehow manage to sound both boring and terrifying at the same time. For some people, it's where fortunes are built. For others, it's a giant scam run by billionaires, algorithms, and guys on social media wearing sunglasses indoors. And honestly, both sides have a point. Because the stock market is one of the most important systems ever created, and also one of the most misunderstood. Most beginners think stocks are just numbers moving around on a screen: red, green, up, down. But behind every ticker symbol is something very real: a business, employees, factories, products, customers, entire industries fighting for survival every quarter. And once you understand that, the market starts looking less like a casino and more like a giant battlefield for ownership. Here's how it actually works. Imagine you build a company. Maybe it's a coffee business. At first, it's small: one location, a few employees, long hours, probably terrible sleep. But the coffee's good. People show up. The business grows. Soon, you want a second location, then a third, maybe an app, delivery partnerships, advertising, expansion into new cities. There's just one problem. Growth is expensive. You need money. Now you could borrow from banks. That's one option. Or you could do something far more interesting. You could sell pieces of your company to the public. That process is called going public. An IPO, initial public offering. This is the moment a private company transforms into a publicly traded company. Which sounds technical, but really means this: regular people can now buy tiny ownership pieces of the business. Those pieces are called shares. And suddenly your little coffee company becomes something entirely different: a stock. Now imagine your company is divided into 1 million shares. If someone buys 10,000 shares, they own 1% of the company. Not metaphorically, legally. They own part of it. That's the core idea most people miss. When you buy a stock, you're not buying a random digital token. You're buying ownership. Tiny ownership, usually, but ownership nonetheless. And if the company grows, becomes more profitable, expands globally, or dominates its industry, that ownership can become more valuable over time. Simple in theory, completely chaotic in practice. Because once shares hit the stock market, their prices start moving constantly, every second. Why? Supply and demand. If more people want to buy a stock than sell it, the price rises. If more people want to sell than buy, the price falls. That's it. That's the engine underneath the entire market. But human beings have a special talent for turning simple things into emotional chaos. And that's exactly what investors do. Because stock prices are not just driven by facts, they're driven by expectations. A company could make billions of dollars and still see its stock collapse. Another company could lose money for years and its stock skyrockets anyway. Which sounds ridiculous until you realize the market is obsessed with one thing: the future. Not today, tomorrow. Investors are constantly asking, will this company dominate AI? Will it survive a recession? Will it invent the next big technology? Will people still care about it in 10 years? And those guesses become prices. That's why the market often feels irrational. Because it is, at least in the short term. A rumor can move billions. One bad interview can erase a company's value overnight. A single tweet used to shake markets. Now, AI-generated headlines can do it in seconds. And in 2026, information moves faster than human emotions can process it. That matters more than most people realize. Because modern investing no longer happens slowly. Decades ago, people literally called stockbrokers on telephones to place trades. Now, a teenager can panic sell thousands of dollars worth of stock while waiting for food delivery. The friction disappeared, and when friction disappears, impulsive behavior explodes. That's partly why investing became entertainment. Apps turned trading into a game. Bright colors, notifications, trending stocks, viral screenshots of overnight profits. Everyone suddenly looked like a genius during bull markets, especially online. And this created one of the strangest financial eras in modern history. People started confusing luck with skill. During the meme stock craze of the 2020s, some stocks skyrocketed thousands of percent almost purely because online communities decided to buy them together. Fundamentals barely mattered. Profits barely mattered. Sometimes the companies themselves barely mattered. It was momentum feeding momentum. People buying because prices were rising, and prices rising because people were buying. Until eventually, reality showed up like an unpaid tax bill. Because no matter how exciting markets become, one uncomfortable rule always returns. A business eventually needs to make real money. Not hype, not vibes, money. And this is where beginners often misunderstand what investing actually is. Investing is not predicting lottery tickets. It's evaluating businesses. That means revenue, debt, competition, profit margins, leadership, economic conditions. The boring stuff nobody posts about. Ironically, the people who often succeed long-term in the market are not the most emotional or exciting investors. They're usually the most patient, which sounds deeply unimpressive in a world addicted to speed. But patience is brutally powerful in markets because of compounding. Compounding is one of those ideas that sounds harmless until you see the math. Small gains repeated over long periods create absurd outcomes. If someone consistently earns average market returns and reinvests their gains, time starts doing most of the heavy lifting. The problem is, human psychology hates waiting. People want results immediately. They want the stock to double next week, triple next month, retire by 30. Social media amplified this obsession massively. You rarely see videos titled, "I slowly built wealth over 27 years through disciplined investing." Too realistic, too boring. Instead, the internet rewards extremes, massive wins, massive losses, panic, euphoria, and the market feeds on emotion beautifully. Fear and greed are basically the fuel source of Wall Street. When prices rise rapidly, people feel smart and buy more. When prices collapse, fear spreads and everyone rushes for the exits at the exact same time. That's why crashes happen. And crashes reveal something important. Most people don't actually know their risk tolerance until they watch money disappear in real time. It's easy to say, "I'm investing long-term during a bull market." It becomes much harder when headlines scream recession, layoffs, inflation, geopolitical conflict, or banking crises. That's when psychology takes over, and psychology moves markets more than people want to admit. In fact, the stock market is often less like a calculator and more like a giant emotional mirror reflecting collective human behavior. Optimism pushes prices up. Fear drags them down. Then, optimism returns again, over and over, for more than a century. But underneath all the chaos, something important has historically remained true. Businesses innovate, economies expand, productivity improves, And over long periods, markets have generally risen alongside human progress itself. That's why governments care deeply about markets. Retirement systems depend on them. Pension funds depend on them. Entire economies depend on consumer confidence staying alive, which leads to a strange realization. Even people who never buy stocks directly are often still connected to the market through retirement accounts, insurance systems, banks, or employment. The market is woven into modern life, whether people understand it or not. And now, artificial intelligence is changing the system again. In 2026, huge portions of trading activity are already handled by algorithms. Machines analyzing news headlines in milliseconds, scanning earnings reports instantly, tracking shipping routes, satellite images, social trends, even weather patterns. Some firms spend billions trying to be microseconds faster than competitors. Microseconds. That's how intense the competition became. The stock market started as a place where businesses raised money. Now it's also a technological arms race. Humans competing against algorithms built by other humans, trying to predict the behavior of millions of strangers they will never meet. And maybe that's the strangest part of all. The stock market looks like it's about money. But underneath the numbers, charts, and headlines, it's really about belief. Belief in the future. Belief that companies will grow. Belief that innovation continues. Belief that tomorrow will be more valuable than today. Every stock price is ultimately a prediction about what humans think the future will look like, which means the market is not just measuring companies, it's measuring confidence itself. And maybe that explains why the stock market feels both powerful and fragile at the same time. Because confidence can build empires, but confidence can also vanish overnight. The people who understand markets earliest usually discover one uncomfortable truth. The economy rewards labor, but wealth increasingly rewards ownership. And those are not the same thing. So the real question isn't whether the stock market will continue growing. The real question is, what happens to a society where more and more wealth comes from owning assets? Maybe that's the biggest misunderstanding about the stock market. People think it's just a place where money moves, but it's really a place where ownership moves. Ownership of companies, ownership of technology, ownership of industries shaping the future. And whether people realize it or not, that future keeps rewarding the people who own pieces of the system more than the people simply working inside it. That doesn't mean the stock market is evil. And it doesn't mean everyone investing becomes rich. But it does mean one thing is becoming painfully clear in 2026. The gap between owning assets and not owning them is changing how people live entirely. Because over time, salaries grow slowly, but ownership can grow exponentially. And maybe that's why the stock market matters so much. Not because of flashing charts or viral trading apps, but because somewhere behind all the noise, billions of people are trying to answer the same question. How do you stop working only for money and start owning something that works for you too? If this helped you, apply it today, not tomorrow. See you next video.